Welcome. Today, we're providing a deep dive analysis into the strategic shifts at Rainbow Shares, or CHGGF. The company is at what we see as a critical inflection point, one that's creating a fascinating story of two distinct businesses under a single corporate umbrella.
So let's get straight to our core thesis. We believe there's a significant disconnect between how the market currently values CNHGF and the fundamental transformation that's actually happening inside the company. This disconnect is really driven by three key factors. First, the market's valuation seems to be firmly anchored to the company's legacy cyclical panel business. Second, a deliberate strategic pivot into high-barrier substrate class is fundamentally changing the company's entire risk and growth profile. And third, the recent alliance with BOE is a major catalyst that both validates their technology and puts a firm value on that legacy business.
Here's how we'll structure our analysis today. We'll start with the prevailing market view and the short-term pressures. Then we'll dive into the strategic pivot to glass. After that, we'll examine the BOE alliance and its role as a catalyst. This will lead us to reevaluate the company's corporate value before we finish with a look at the outlook, including key risks and metrics to watch.
Okay, let's begin with Section 1, the market's current perspective. We need to understand the data that's shaping this cautious sentiment.
This was the headline number that really captured everyone's attention. A 50.69% year-over-year decline in Q2 net profit. You know, a number like that is bound to trigger an immediate and negative market reaction.
And you can see that reaction play out right here. The correlation was direct and clear. In the period right after that earnings report, CHGF stock significantly underperformed the broader CSI 300 index, which, as you can see, held relatively stable.
So this market action really reinforces a specific story, a specific narrative, that CHGF is, at its core, a low-margin, cyclical panel manufacturer that's just facing the usual industry headwinds. It's this perception lag that is absolutely central to our analysis.
And that brings us right to the heart of the matter, the company's fundamental pivot away from that legacy business and into high-barrier materials.
Now, to really understand this pivot, we have to define what G8.5 plus substrate glass is. This is not just another component. We're talking about a critical, high-barrier upstream material. It's technologically complex to produce, it's absolutely essential for large-screen display manufacturing, and it's key to securing domestic supply chain independence.
This means the company is effectively becoming a tale of two businesses. On one side, you have the legacy panel business, cyclical, lower margins, what we're calling the past. On the other, you have the emerging substrate glass business, high growth, high-tech, strategic, and very much the future. The strategy is a deliberate shift of focus and resources from one to the other.
Now, a strategic pivot of this magnitude needs a catalyst to really get it moving. For CHGF, that catalyst arrived in the form of a landmark alliance with an industry giant, BOE. And the first thing that signals the importance of this deal is simply the scale. We're talking about a cash investment of nearly 48.5 billion RMB from BOE. That's for a substantial stake in CHGF's panel manufacturing subsidiary.
But this alliance is about far more than just a financial transaction. From a strategic point of view, it accomplishes three critical things. One, it secures a major downstream customer. Two, it validates the company's core technology. And three, and this is crucial, it anchors a clear, market-based value for that legacy panel business.
The underlying motivation here is perfectly captured in this quote. It's about supply chain resilience. This isn't just two companies doing a deal. It's a strategic move to secure the supply chain for the entire domestic display industry. It's a strategic imperative. So, with these two very distinct businesses operating inside one company, it becomes obvious that a standard, one-size-fits-all valuation is insufficient. A more nuanced framework is absolutely required. You see, during a profound transition like this one, standard metrics like a blended PE or PB ratio don't just fall short. They can be actively misleading. They end up masking the distinct value drivers and the true potential of each separate business segment. This is why a sum of the parts analysis, or SOTP, provides a much clearer lens. This framework lets us value the two businesses separately. We can anchor the panel segment's value to the price set by the BOE transaction. Meanwhile, we can assess the high-investment glass segment using an asset-based approach, like its net asset value. All right, to conclude, let's turn to the outlook. Now, we're not going to offer a prediction. Instead, we'll provide a framework of the key risks and the crucial metrics to monitor as this strategy continues to unfold.
Objectively, several downside risks need to be on the radar. Execution risk is paramount, particularly around managing the technology and, critically, the yield rates in the new G8 Plus glass production. External factors also matter. A prolonged downturn in panel prices could hurt cash flow, aggressive competition is a given, and of course there's the long-term risk of new technologies making this one obsolete.
So those are the risks. Now here are the crucial data points to watch. The gross margin of the glass business will be the ultimate proof of its competitiveness. Procurement volumes from BOE will validate the strategic value of the alliance. And finally, any need for large-scale external financing will be a key signal of how well the company is managing its cash flow versus its capital needs.
And all of this brings our entire analysis down to one central question. It's a question not just for CHGF, but for any incumbent company trying to navigate a transforming industry. Can a long-term strategic transformation outpace the intense, short-term pressures of its legacy business cycle?